Very good morning to all. Very good morning on this bright day on for our presentation on the insights on UAE corporate tax in partnership with the Sharjah Research Technology and Innovation Park. Before we start our presentation, let us introduce ourselves. We are Jitendra Chartered Accountants, part of Jitendra Consulting Group. We are formed here since more than 20 years, established in 2001. We are having an offices in Dubai and Sharjah, and we have an international network in 150 countries. We have on board many clients, many flagship clients, and we have a team of qualified chartered accountants, company secretaries, lawyers, and MBAs. We are also FTA registered tax agent and tax agency, where we can help you in any kind of a VAT related matters, excise matters, or and going forward with the corporate tax. We are approved with major banks and free zones, including SRTIP. Our services include auditing, bookkeeping, liquidation, ICV, in-country value, AUP. Then on compliance side, we have anti-money laundering services, economic substance regulations, ultimate beneficial owner, VAT, corporate tax, and we have another division, Jitendra Business Consultants, where we form the companies and provide the advisory for any kind of a legal structure they require for. And we have another group company called Jitendra Intellectual Property, where we register the copyrights, trademarks, not only in UAE, but all over the world. And we also provide the management consultancy. With this, a very short brief with you today, me, Rajiv Thakkar, and Ms. Deepa Rai is here to present you with our insights on UAE corporate tax, which we believe should be very full, very insightful to the SRTIP and the SRTIP's investors. With this, I request Ms. Deepa Rai to start with our today's presentation.
Thank you, Mr. Rajiv. Good morning, everyone. Thank you for joining us today in this webinar. This webinar will basically provide you all with an insight about UAE corporate tax that we all know is going to come into effect in the month of June 2023. So the entire discussion which we are going to have today is based upon the public consultation draft that was issued by the Ministry of Finance in April 2022. With these insights, the companies can look into their financial statements and they can do any sort of structural changes, like they can change the shareholding structure or any accounting structure changes can be done, for better tax planning. But the point to note here is that any final decisions related to such structural changes, such decisions should be done only when the final decree law has been issued. So for now, let's just see what does the public consultation draft states. The first topic that we are going to discuss today is taxable persons. So the UAE corporate tax will be applicable on the type of persons included in the law. Let us understand what type of persons will be considered as taxable persons. The first category as a taxable persons is natural persons. Natural persons basically means individuals like us. This corporate tax is not applicable on the individual's personal income. However, if any natural person or if any individual, if they are running any business or some sort of commercial activity, like for example, sole establishments, then in that scenario, in that case, corporate tax will be applicable on the business profits of the individual. Just to echo or reiterate the above point, this corporate tax, which we are and will be discussing further in detail today, this will not be applicable on individuals' personal income like salaries or if they have earned any sort of income from rental receipts or they invested into a company's stock and now they are receiving dividends on that stock. So such income will be, corporate tax will not be applicable on such income. The next taxable person is legal persons. Legal persons basically means entities or corporates or organizations, firms, and so on. So this corporate tax, it will be applicable on all the UAE companies, which means any entity that is getting incorporated in the UAE, or if there is an entity which is incorporated in some other country, but its source of income is being generated from UAE, then such companies will be subject to corporate tax. When we are saying that the entity is not incorporated in UAE, it basically means that it's a foreign entity. So when it comes to foreign entities, the major point to note is that even though the entity is not incorporated in UAE, but it has a permanent establishment, which means that it is being managed and all the business decisions are being taken in UAE or from UAE, then corporate tax will be applicable on them. So just a couple of examples of legal persons could be like limited liability company, then public listed companies or private stockholding companies, and so on. Now, the next topic that we'll discuss is basis of taxation. Over here, we will understand on what basis are we going to decide whether corporate tax will be applicable or not on a particular taxable person. One of the major elements in order to check if a particular business is subject to corporate tax or not is its residency. If a company is incorporated in UAE, then it will be automatically considered as a resident person. Okay. A foreign entity can also be referred as a resident person, provided the company is being managed and its key decisions are being taken in the UAE territory. In some cases or in some scenario, the source of income could be from outside the UAE. Then in that case, if income tax was paid in the foreign country, then in order to avoid the double taxation, what the company can do is they can claim tax credit. Okay, they can claim such tax credit against the corporate tax that they are liable or they are being expected to pay in the UAE. Now, this was all about residents. Now, what about non-residents? Is corporate tax applicable on them? So to answer that question, yes, corporate tax will be applicable on non-residents as well. But when? So non-residents will have to pay the corporate tax if their source of income is being generated from the UAE or if their taxable income is coming from its permanent establishment, meaning the entity has a fixed place of operation in the UAE from where the business is being wholly or partly carried on. So in such scenarios, non-residents are liable or is expected to pay corporate tax. Now, this was all about taxable persons who are liable to pay tax or on whom corporate tax will be applicable. In the next slide, we'll see who will be exempted or who will be basically relieved from UAE corporate tax. So let's say any government departments, okay, or any authorities, or there are some companies that are being wholly or majority of the shares is being owned by a government. Then for such companies or for such government departments, corporate tax will not be applicable. Then there can be a few charities, there will be NPOs like non-profit organizations who are listed as approved entities in the cabinet decision. So corporate tax will not be applicable for such charities and NPOs as well. Then in some cases, there will be few businesses, who are their nature of business would be production and extraction of natural resources. So for such companies, the taxation would be emirate level taxation, and that taxation is applicable as per the Constitution. For such companies, UAE corporate tax will not be applicable. Then there can be investment funds that are subject to corporate tax exemption. But in order to meet that exemption or to enjoy that corporate tax exemption, they will have to meet certain conditions. So these were few examples of exempt persons. Now, along with exempt persons, we also have income that can be exempted from corporate tax. So let's see what are those income. So if a company has invested into some another company, okay, and it is receiving any sort of return, like for example, it is receiving a dividend by investing into another company, then such income will be exempted from corporate tax. And then there can be a scenario, a UA company, it has a foreign branch or it has a foreign subsidiary. Okay, then income from such branch, from such subsidiary will also be exempted from corporate tax. Now, what about dividends and capital gains? So dividends, if you're receiving a dividend or if you have received a capital gain by as a shareholder, then such income will also be exempted from corporate tax. If you're receiving a dividend from a UA company, from a domestic UA company, or from a free zone person, but free zone person who are subject to 0%, if you're receiving dividends from such companies, then those incomes, those dividend and capital gain will also be exempted. Now, if you're receiving dividends by foreign companies, or you say received a capital gain by selling shares in both UAE or in foreign company, then even that income will be exempted. But again, there will be certain conditions that the company will have to meet in order to enjoy that corporate tax exemption. The point to note here is that such exemptions will be applicable only if the foreign subsidiary is subject to corporate tax at least at 9% in that foreign jurisdiction. Only then they can claim the exemption for foreign subsidiary. The next is foreign branch profit. So if a UAE company has a foreign branch in a different jurisdiction, okay, then in that scenario, the UAE company has two options. First, either it can claim a foreign tax credit, okay, or it can elect themselves to be exempted from the corporate tax. But again, to do so, to select either of the option, the foreign, it is required the foreign branch is paying sufficient level of foreign tax in its jurisdiction country. Only in such scenarios, the foreign branch profit will be exempted from corporate tax. Now, one more income that is exempted. Let's say, for an example, you have a non-resident company over here, okay, but your income is being generated because you're operating or you are leasing an aircraft, or let's say you are operating a particular ship that is basically used in international transportation, then such income will also be exempted. But again, there's a condition laid over here which states that same tax treatment is being granted to a UAE business in that foreign jurisdiction. Only then now a non-resident company, UAE non-resident company will be allowed for exemption for certain income. So this was all about taxable persons who are liable to pay tax, then exempt persons who will be relieved from corporate tax. What are the exempt income which will be exempted from income tax, corporate tax? Sorry. So up until now, we have understood the taxable persons and exempt persons. Now from here, I would like to hand over the presentation to Mr. Rajiv to discuss the further slides about free zone persons.
Thank you, Ms. Deepa. Thank you for starting our webinar and giving us the initial brief about the UAE corporate tax based on the public consultation document. Now, in our presentation, we have come with our first treasure, the applicability of the UAE corporate tax on free zone persons. I remember in mid-2017, there was a first seminar by the Ministry of Finance on the value added tax. But the Ministry of Finance has not clarified anything on the applicability of the value added tax, or in short VAT, or the free zone companies or free zone persons. But luckily, in the first public consultation document issued by the Ministry of Finance, we have our treasure, the applicability of corporate tax, UAE corporate tax on the free zone persons. And as we are in the SRTIP, so this will be our first concern. So let us go through each one. Now, what are the free zone persons? Any companies and branches that are registered in a free zone will be known as the free zone person. Now, at presently, there are free zones which are giving the tax incentives to their companies, or I can say to their investors. The public consultation draft of UAE corporate tax is continuing the same, is honoring that tax incentive and confirming that the UAE corporate tax applicable on the free zone persons will be 0%. So yes, it's a time to joy that we are at 0%. The SRTIP investors are at 0%. Now, to claim the 0%, we have certain conditions that we have to follow, certain transactions which are covered under 0%. So let us go through one by one. First is the conditions to claim 0%. In that, the first condition is the tax return filing is compulsory. Even if the free zone person or SRTIP investor, or I should say you, even in the free zone, your corporate tax applicability is 0%, but the tax return filing is compulsory. If you want to claim 0%, tax filing is compulsory, and compulsory audit. Audit of books of accounts is now become mandatory not only for free zone, but all over the UAE for specifically for the corporate tax purposes. Now at here, they say that you need to maintain an adequate substance. Now the definition of adequate substance at presently is not given in the public consultation draft, but if we go back to 2019 and then 2020, wherein we have the law of economic substance regulations, which very well says that what adequate substance is, which says that the company should have an adequate space, adequate employees to match with their revenues. It has to be directed and managed in the UAE. So for now, the meaning of adequate substance, we will understand based on the ESR, which I explained to you. And they say that you need to comply with all the regulatory requirements. Now, these are the 4 conditions, which says that if you want to claim 0% corporate tax being a free zone person, you have to maintain. Now, let us understand, like what kind of businesses or what kind of transactions are coming under a 0% corporate tax. So, the public consultation document says that when a free zone company is doing transactions with businesses who are located outside of UAE, like exports, businesses located in the same free zone, inter-free zone, and businesses located in the other free zone, intra-free zone. So the public consultation draft says that if a free zone company is doing export, business within free zone or with other free zones are eligible to claim 0% corporate tax rate, and other is income from certain regulated financial services directed at foreign markets. So they have clearly mentioned that if a free zone company is doing only this, any of these 3 kind of or 4 kind of businesses, then only they can claim the 0% corporate tax exemption. Now, we have seen that there are many companies who has a different kind of legal structures. Like some free zone company will have a branch in mainland, or some free zone company will have a related party or the connected person in the mainland. So let us understand one by one, like what will be the applicability. In that, first is if a free zone person or a free zone company is having a branch in the mainland UAE. So at here, it is simple that for the mainland source income, for the mainland branch, 9% common taxes are there. But for the free zone, there is one condition that if a free zone company is maintaining separate books of accounts for their free zone company and the branch, then only on the free zone income they can claim 0% corporate tax rate. But if the free zone company is not maintaining separate books of accounts. Let's say that a company is maintaining only one books of accounts for the free zone and the branch in mainland, then the free zone income will also come under 9% corporate tax rate, and the mainland source income is already at 9%. So at here, the first advice comes that if the free zone company, you are having any kind of branches in the mainland, so start maintaining separate books of accounts. Even if it is your branch, maintain separate books of accounts. Moving further, that a free zone company can have the group companies located in the mainland UAE. So what will be the applicability in the UAE corporate tax? For free zone persons, it's still 0%, but listen carefully, but payments made to the free zone person by a mainland group company will not be a deductible expense. By saying this, that if, let's take an example, let's say a mainland company is buying some goods from the free zone company. So the free zone company still claim a 0% corporate tax rate, but the mainland company will not be able to have a deduction of that purchase for the calculation of the taxable income for the UAE corporate tax purpose. Now, over the screen, there is a small table of example. I request all of you to go through it, so then we can discuss. So now I hope everybody has gone through this example. So let us understand. We have a situation A, wherein there is a mainland company who is purchasing from a third party. So their sales is 2 million. They are purchasing from a free zone third party for 1 million. So yes, they can claim the deduction, and the gross profit is 1 million. So on 1 million, there is a profit exemption, corporate tax exemption of 375,000 dirhams. So on the balance, they paid 9%, 56,250 dirhams. Now let us come to situation B, that a mainland company is purchasing from a free zone related party. Now their sales, we kept it same as 2 million, but as the mainland company is purchasing from a free zone related party, so they will not be able to get a deduction of their purchase of 1 billion. So their income will, gross profit or corporate tax, taxable income will be 2 million, and on that corporate tax will be 146,250 dirham. So we can clearly see that by not getting a 1 billion deduction, the company is paying 90,000 extra for as a corporate tax. Now we have understood various applicabilities of the corporate tax on the free zone. So we have sum up on over this slide. So I again request all of you to go through the same, and then we will discuss. I hope everybody has gone through the table. It's a simple table. Whatever we discussed in our previous 3 slides, we have just summed up that. Let us go through one by one. First, AFZC, who is doing exports outside UAE or doing the business within the same free zone or doing the business outside the free zone. So corporate tax applicability on particular AFZC is 0%. Now BFZC, who is having a mainland branch. If they maintain separate books of accounts, then corporate tax on BFZC will be 0%, and on the mainland branch it is 9%. But if the separate books are not maintained, then the corporate tax on the mainland as well as free zone company will be at 9%. And coming to our last example, CFZC, wherein the mainland company is buying from the group company. So the applicability of corporate tax on the free zone person still remains same 0%, but the applicability of corporate tax on the mainland will be at 9% with a disallowance of payments for purchase from free zone person. So at here, now we broadly understood that what free zone person, how a free zone person can claim a 0%. What are the conditions? What are the businesses are there? Now, the businesses, what a free zone person can do, give us a little idea that what a free zone person cannot do. So that is our next topic is disqualification of 0%. So any other mainland source income will disqualify a free zone person from the 0% corporate tax regime in respect of all their income. Now we all know that the basic idea of forming a free zones in UAE was to provide the free zone person 100% ownership and also to restrict them that you can do businesses within free zone out, outside UAE or with other free zones. So the corporate tax is on the same line and saying that if the free zone company is having any mainland source income, that will disqualify free zone person from the 0% corporate tax regime. Now, in this, if a free zone company is having one transaction of mainland source income, will disqualify them from 0% and all of their income will come under a 9%. It is not that only that mainland source income will come under 9%. No, all of the income of that free zone person will be taxed at 9%. So now on, the free zone persons when dealing with the mainland companies has to keep these things in mind. But here is an exemption. Here is some relief which UAE Corporate Tax has given us. Now, this relief is enjoyment as a designated zone person. Now, we all know that we are in the value-added tax era in the fifth year. We have almost completed 5 years in the UAE value-added tax. So we all know what is designated zone person. The designated zone persons are designated zones are which are bounded by the fencing, wherein the entry and exit of the goods or the main car is controlled through a gate pass system. So a free zone person who is in a designated zone for VAT purposes can benefit from the 0% corporate tax rate even when doing businesses with the mainland if the mainland company is clearing the goods from the customs. So to give you a more better understanding that under VAT, if the import RCM, import reverse charge mechanism is on the mainland company, then the free zone company can claim 0% corporate tax on their all the transactions. But if the designated free zone company is clearing the customs, is paying the import reverse charge mechanism, is paying VAT under import reverse charge mechanism, then on all of their income, 9% corporate tax will be applicable. Moving forward, there are some withholding tax. UAE corporate tax public consultation document has come up with the concept of withholding tax that a free zone person who is benefiting from the 0% corporate tax regime in respect of mainland source income, such income will be subject to 0% withholding tax. So if you have any income from the mainland source income, like just now we discussed for being a designated zone person, if you have any income for the 0% withholding tax will be applicable. Now, at here, the UAE corporate tax public consultation document do not want to be very harsh on the free zone companies that you cannot have like any income from the mainland. They have given some exceptions also that you can still benefit from the 0% corporate tax if you earn any kind of passive income. Now, those passive incomes are like interest, royalties, dividends, or capital gains from owning shares in mainland UAE companies. So yes, they have given another relaxation apart from designated zone person, passive income. That if you are earning a passive income, so 0% corporate tax rate You can claim subject to the conditions which we discussed in the start, like tax return filing is compulsory, audit is compulsory, education substance is required, and the other compulsion requirements. Now at here, the UAE Corporate Tax is giving a one-time selection to the free zone company. That okay, you are in a free zone, fine. You want to claim 0% or 9%. So yes, a free zone person at any point in time be able to make an irrevocable election. Irrevocable election means once you have made some kind of decision that you cannot reverse. Like a free zone company cannot say that okay, for 1 year I'll I'll go for a corporate tax rate at 9%, and another year they say no, we want to claim a 0% exemption. No, that is not possible. So they have said that irrevocable election, that one-time decision you need to make, that you want to be at 0% or you want to be charged at regular corporate tax rate of 9%. So this is our summary on the applicability of the UAE corporate tax based on public consultation document on the free zone companies. Now let's move forward. Groups. Now we all know that in the value added tax, we can create a tax group, a VAT group. But in the value added tax VAT, there is a simple condition that if a single person is common holding in the companies, then yes, you can create the tax group. But in the corporate tax, this condition is not the same. The condition is the UAE resident group of companies can elect to form a tax group and can be treated as a single tax person if the parent company holds at least 95% of the share capital and voting rights in its subsidiaries. Now, when we compare with VAT, there is a simple condition. One person is common, you can create the VAT group, but in the corporate tax, there has to be a parent company who is holding at least 95% of the share. And there are some restrictions that the parent company or any of the subsidiaries cannot be the exempt person, which Ms. Deepa has explained to us. And that person should not be a free zone person who is claiming a 0% corporate tax rate. So if you have a group companies, you can create a tax group by following these three conditions: that parent company should hold at least 95%, the parent company or subsidiary should not be exempt, and they should not be a free zone person claiming 0% corporate tax rate. And there is another condition common for us, all group members must use the same financial year. So this is something not new, because as we are already in the IFRS, International Financial Reporting Standard, so every group is maintaining a same financial year to see the overall group's profitability. So yes, we are already maintaining this, and the same condition is they have put in the public consultation document that all group members must use the same financial year, and a subsidiary can be part of that tax group, or if it is a UAE branch of the parent company. Now, we have created a tax group, and by creating a tax group, there can be possibilities that intergroup we can transfer the assets and liabilities. Now they have given us separate that intragroup transfer will be available to those companies who could not create the tax group. See, when we already have a tax group, so okay, we can do the intragroup transactions, and we do intragroup assets and liabilities. Ultimately, on that, there will not be any impact on the corporate tax. But there will be some groups or some companies who cannot come under the one umbrella, cannot come under the tax group. So there we can make there is one facility that we can do the intergroup transfer of assets and liabilities, having the condition that 75% should be common ownership. If we have 75% common ownership, so intergroup transfer of assets and liabilities can be possible without any gain or loss for the UAE corporate tax purpose. Now, there are some conditions for this. Now, which are these conditions? We will see in detail when we have the final corporate tax law. Now, transfer of losses. The group can transfer tax losses from one group company to another group company with profits subject to some conditions. Now, same like just now we discussed intra-group transfer of assets and liabilities. So same way, there can be some groups who cannot come under one umbrella, we cannot create the UAE corporate tax group. So still, if one company is under loss and another company is under profit, we can transfer losses between both of them, but the conditions are there. The condition is same, what we discussed previously, 75% common ownership, and the transfer will not happen with the exempt companies or the companies who are benefiting from the 0% corporate tax free zone process. So the conditions are the same, 75% common ownership and no exempt, no free zone person claiming 0%. So if we meet such conditions, then the two companies who are not under the same tax group can still transfer the losses and can save their cash outflow. Under the law losses, we have another slide is there wherein any company can carry forward the losses indefinitely in their corporate tax return. But when they are offsetting the loss with another group company is not under the same tax group. So by doing that, those group companies are saving their cash outflow in that year. And how much will be the tax loss offset we can do? It is maximum up to 75% taxable income of the company receiving the transfer losses. It is not like that. Let us take an example that one company is having a 1 million loss and another company is having a 500,000 profit. So anyone in the normal scenario will say that, okay, I have a profit of 500,000. So, okay, I'll set off with another company is having 1 million loss. So I'll pay nil tax. No, they are saying that you can claim only up to 75% of the taxable income. So in this case, my taxable income is 500,000. So up to 75% means 375,000 grams we can claim as a deduction, and balance 125,000 we need to pay taxes. And on the other side, the company who was bearing the losses, having a 1 million loss, so their carry forward loss will be 1 million minus 375,000. So balance 625,000 grams they can carry it forward. So now at here, some group relief are given that the corporate tax regime will allow certain corporate reorganization transactions, that's mergers, to be undertaken on a tax neutral basis such that no gains or losses arises. Now coming back to VAT. Now you all must be wondering that why am I like continuously going on the VAT? Because to make you understand the UAE corporate tax better, because in the VAT we are already there for 5 years. So when I'm relating some provisions with the VAT, so it will be more clear to you. Now at here under the VAT we have we have one term, going concern basis. So if there is any sale of the on a going concern basis, so there is no impact on the VAT. So same condition, same provision has been here also, that if you are doing any kind of reorganization like mergers, then that can be taken as a tax neutral basis going forward. Now, here comes the alarming part of our UAE corporate tax and our webinar, related parties and transfer pricing. Now, let us understand who are related parties. Or I should say that we all know who are related parties. Like a related party is an individual or entity who has a pre-existing relationship with the business that is within the scope of the UAE corporate tax regime through ownership, control, or kinship. Related parties we all know. But why in the UAE corporate tax? Because when we do a transaction with a related party, when we are doing a transaction with a related party, the relation is affecting the transaction value. And by doing so, the companies can manipulate their taxable income by paying less corporate tax in UAE. So, to control that, the UAE corporate tax has come up with the transfer pricing rules that any related party transactions has to be done on a internationally recognized arm's length principle. Now, arm's length principle are the principles that if a company is selling to a third party or to a related party, should be charging the same price. That's in a common man, simple definition that if a company is selling to a third party or a related party, should be charging the same price that we all understand for the arm's length purpose. Now, the UAE corporate tax public consultation document has said that what arm's length principle we are required to follow. So, all related party transactions and transactions with connected persons. Now, what is connected persons? It is there in our next slide. Will need to comply with transfer pricing rules and the arm's length principle as set out in the OECD. So, now this is some kind of warning, some kind of alarm to us that at presently the related party transactions or the connected persons transactions at we are at presently doing as per our convenient. The pricing is as per our convenient. But now when we are in the corporate tax regime, now the UAE is coming up with the corporate tax. So now no more. So now no more under or overpricing to the related parties. The transaction with the related parties has to be at the arm's length and as per the parameters or the principles set out by the OECD. Now, when we follow this OECD principles, so the UAE corporate tax requires us to keep some documents. So those documents are that we need to submit disclosure of a transaction with related parties and connected persons. Now, we have done many audits and we are maintaining the books of accounts as per the International Financial Reporting Standards. So under IFRS IS 24, which states that whatever transactions with the related parties has to be mentioned in the audited financial statements. So now we have another requirement that those transactions apart from disclosing in the audited financial statements, we have to disclose with our corporate tax return. And at the same time, we need to maintain a master in local file where the arm's length value of the related party transactions exceed a certain threshold in the relevant tax period. Now, what is this master file and local file? For that purpose, we need to go to the OECD principles. But at presently, let's concentrate more on the what are the other requirements or other provisions of the UAE corporate tax under the public consultation document. Now, at the transfer pricing, I told you connected persons. Now, this is something new. This term connected persons is something new. Who are the connected persons? An individual who directly or indirectly has an ownership, interest, or controls the taxable person, director or officer of the taxable person, related party, and an individual related to the owner, director, or officer of the taxable person to the fourth degree of kinship or affiliation by birth, marriage, adoption, or guardianship. Now, to sum up, that who are the connected persons? Like the shareholders of the company, directors of the company, and their relatives are the connected persons. Now, why we are discussing this connected persons at here? Now, as Ms. Deepa has mentioned, that there is no individual UAE corporate tax on us. So, what can happen that a company will give more managerial remuneration to its directors or its owners to pay less UAE corporate tax. But our UAE government is more smarter than us. So they have said that payment or benefits provided by a business to its connected persons will deductible only if they demonstrate two things. Simple things that the payment are as per the market value, like we discussed arm's length, and the same is being incurred wholly and exclusively for the taxpayers business. So our government is very smarter than us. They have understood at the initial draft itself that where being a taxpayer or being a taxable person, where we can manipulate the corporate taxes. So they have come up with this connected persons restrictions that any payment has to be at per the market value and should be exclusive for the taxpayers business. So this is from my side, the presentation on the applicability of the UAE corporate tax on the free zone persons, how we can form a tax group, what are the conditions for the related party transactions, and what are the conditions for the connected persons. From here, I request Ms. Deepa to take us to rest of our presentation. To Ms. Deepa.
Thank you, Mr. Rajiv. So till now, we have seen all the good things of the corporate tax, like 0% corporate tax to free zone persons. But as we all know, each coin has its two sides, right? So from here on, our road starts with few speed breakers. Let's just see what these speed breakers are. The first bump in our road is maximum deductible interest. If your company has borrowed a certain amount for business purpose, then obviously it is expected to pay a certain amount of interest on that loan, right? In this case, your company can basically claim the interest payment as deduction. But again, there is a certain limit for such deduction. That deduction limit is 30%. Now we know the deduction limit is 30%, but the 30% will be calculated on which amount, right? So this 30% deduction will be done basically on the earnings that a company has derived before deducting any sort of interest or say tax or depreciation amount. So the amount they received before deducting all such expenses, interest, tax, and depreciation will be used for calculating the 30% deduction of interest payment. Now, here, some of you might raise a question that why not 100% deduction on interest payable and why only 30% limit? So to answer that, the company may claim for 100% deduction, but at present, the public consultation draft does not, provide proper requirements as in order to do such claim. What will be the conditions and when it can be claimed and so on. So let's just hope that the future corporate tax law that is going to come into effect in the June 2023 will provide us a better clarification in regards to this particular point. The next thing we are going to discuss is related party borrowings. Considering the above scenario of borrowing, let's say instead of borrowing from a bank, you have borrowed a certain amount from your related party. Then in such scenario as well, the company needs to ensure that such transactions are being done at arm's length. Now, Mr. Rajiv already explained what arm's length principle is, but just to reiterate that term, it basically means that all such related party transactions should be in the same manner as it would have been with the third party. And the pure reason, the main reason behind this arm's length principle is that the related party relationship could have some sort of influence on the transactions or on the pricing end. Then again, if you're borrowing a certain amount from your related party, you are expected to pay interest on that amount as well, right? So you can claim that related party interest for deduction only when it is intra-group transactions. But again, this deduction, such interest payment deduction is possible only when the company is able or only when the company could prove that the loan that they have taken from the related party is purely for commercial reason and not for personal purpose. Lastly, if your related party is say based in a country where the tax is applicable at 9% or more, then in such scenario, the interest payable amount can be claimed for deduction. And the reason behind that is there's a valid commercial reason in the public consultation draft. But let's say the situation is opposite. The related party is in a country where tax is not applicable at all. Then in such case, the interest amount will not be allowed for deduction. Moving further, we have losses. So if your company has incurred a certain amount of loss, then it can offset, it is allowed to offset such loss amount with its future taxable income. But again, in order to do so, in order to offset their losses, they have to meet certain conditions. Now, what these conditions are? The first condition is only 75% of the taxable income can be set off and not more than that. And the remaining balance of losses will have to be carried forwarded. The next condition is that the company can carry forward the loss for indefinite period. Okay, but again, the condition states that the shareholding structure up to 50% is same for the year when the loss was incurred as well as the year when the loss was offset. Only then they can offset or they can carry forward the loss. But let's say the shareholding structure is not same and there has been some amendments in the shareholding structure. Then in that scenario, at least the business of that company should be same in order to offset that particular company's loss. So this was all about losses. The next topic that we have is non-deductible expenses. In this slide, we will discuss what are the non-deductible expenses. Okay. But before discussing the such non-deductible expenses, let's just understand the definition, the meaning of the term non-deductible expenses. When the company is calculating its taxable income for corporate tax purpose from its accounting net profit or loss, then there are few expenses which will be not allowed for deduction. And such expenses are termed as non-deductible expenses. Now, another synonym of non-deductible expenses is disallowed expenses. Both of these terms are used interchangeably, so please do not get confused. Now, non-deductible expenses is further classified into two. One is partially disallowed and second is fully disallowed. Now, what is partially disallowed? Partially disallowed expenses are basically entertainment expenses. So as a company, if you are incurring any expenditure, okay, on your stakeholders, let's say on your client or on your director or shareholders, then as per the public consultation draft, only 50% of that expense will be allowed for deduction. And the remaining 50% will be added back to the company's accounting net profit. Now, what's the reason behind this addition of 50% back? The pure reason behind this is that such transactions are purely in personal nature, and the business purpose behind such expenses might vanish or might be at a very minimum level. So let's say, for an example, your company has completed 25 years and you have conducted an event to celebrate that occasion. And you invited all your clients, all your shareholders, all your stakeholders and everyone. The overall expense of that event was 20,000. Then as per the public consultation draft that we discussed, only 50% of that expense will be allowed for deduction, which means only 10,000 will be allowed for deduction and the remaining 10,000 will be added back to the company's net profit amount. Now, this was about partially disallowed. What about fully disallowed? Fully disallowed expense is basically are the expenses wherein any such expenses cannot be deducted from the accounting profit. So there is no certain limit of 10%, 20%, 50% deduction. No, such expenses will not be allowed for deduction at any cost. Like the examples of such expenses are, as a company, you have donated a certain amount to a particular charity, to a particular fund, but that charity is not listed as an approved one in the cabinet decision, then the amount that you have donated will not be allowed for deduction. Or another example is that your company has been levied with some fine or some penalties has been imposed on your company, then you cannot claim such amounts for deduction. So this was all about non-deductible expenses. Now we know what expenses can be deducted, up to what limit it can be deducted, and what cannot be allowed, what is not allowed for deduction. Let's just understand the grounds, the basis on which the company will calculate its taxable income. The first point is about the amount that will be considered. So the amount that a company should use in order to calculate the taxable income for corporate tax purpose will be basically the company's book profit or loss amount as per the financial statement. We all are aware that in UAE, the acceptable accounting standard is International Financial Reporting Standards. And hence, all the companies are expected and they are required to prepare their accounts or financial statements as per this standard only. Your company might follow a particular financial year. Let's say your company's financial year is Jan to December. Then same period has to be considered as your tax period. Okay. Then there might be a few company or few firm who are not currently following any financial period, any financial year. So for them, in such scenario, their default tax period would be Gregorian calendar, which is Jan to December. Now, the last point states that if there has been any exchange gain or any losses that a company has calculated at the end of the year, then such amount will not be considered for arriving at the taxable profit or loss amount. So these are few grounds or few bases of calculating the taxable income. Now that we have understood the grounds, let's just see an example. Let's just take 10-20 seconds, just go through the slide, and then I will explain the example that we have considered. Okay. So as you all can see, we have taken two companies as an example, company A and company B. Now, the first thing that we will do is we will calculate the net profit amount of both the companies. So how we'll do that? First thing we'll do is we will deduct the direct cost from the sales value. So we will deduct the 600,000 amount of direct cost from the sales value of both the company. So the amount that we will receive will be considered as gross profit amount. So the gross profit amount for company A is 600,000 and for company B is 400,000. Now the next step is we will deduct all the indirect expenses from the gross profit value. So what are these indirect expenses? So the salaries that you have paid to your employees, you have made rent payments, or you have made water and electricity bill payments, telephone bill payments, there have been any bank finance charges, then you have incurred some entertainment expense on your directors. So we have deducted all these indirect expenses from the gross profit value. So the final value that we receive, that is 450,000 for company A and 250,000 for company B, are basically the net profit value of both the companies. In the next slide, over here, we'll just see how corporate tax will be calculated. So just have a look for 5 seconds. Okay. So we calculated net profit for both the companies. Now we'll just compare the tax threshold amount. So as per the public consultation draft, the tax threshold amount is 375,000, right? So for company B, if we see the net profit amount 250,000 is less than the tax threshold amount 375,000. This basically means that corporate tax will not be applicable on company B. Now coming back to company A, the net profit amount of company A is 450,000, which is more than the tax threshold amount of 375,000, which means corporate tax of 9% will be applicable on company A. Now let's see the corporate tax calculation. So the income, the amount, net profit amount of 450,000. Now what we have done over here is we have deducted the director's entertainment expenses. If we go back to previous slide, there was an entertainment expense of 30,000, director's entertainment expense of 30,000. So if you remember, under non-deductible expenses, we discussed that all the entertainment expenses will be allowed for deduction only up till 50%, which means only 15,000 will be allowed for deduction, which is 50% of 30,000. And that's the reason, while calculating the corporate tax for company A, we have added back the 15,000 amount to the net profit income. By adding so, the amount that we received is 465,000, which is the taxable income of company A. Now on this taxable income, from this taxable income, we will deduct the tax threshold amount, which is 375,000. So the final amount that we will receive, which is 90,000, will be the chargeable taxable income of company A. Now on this taxable income, the tax rate of 9% will be applied. So if we calculate 9% of 90,000, the amount we get is 8,100. So which means that company A is liable to pay 8,100 dirhams tax to UAE government. Now you all can raise a question that why we did not adjusted the entertainment expenses for company B. So to answer that, even if we would have added the 15,000 expenses back to company B profit, net profit amount, the total amount that we would have received is 265,000, which is net profit 250,000 plus 15,000 entertainment expenses. So the amount would have been 265,000, which is still less than the tax threshold amount. And hence we didn't adjusted the director's entertainment expenses for company B. This was just a small example. I hope the corporate tax calculation is clear from this example. Now, we have understood what corporate tax is, how it needs to be calculated, what can be deducted, what cannot be deducted, up to what limit it can be deducted, on whom the corporate tax is applicable, who is exempted from the corporate tax, and so on. Now, in the next two slides, we will just have a look on the proposed compliance requirements that a particular company is required to follow in order to comply with the corporate tax. So each tax registered person can file only one return, as well as they can make only one tax payment for each tax period. Also, the public consultation draft states that it is not mandatory for a company to submit any provisional corporate tax return or any sort of advance taxes. Now, we know we have to file a tax return, we need to make tax payment, but what is the deadline to do so, right? So all the tax registered persons, they are required to file their tax return as well as make the tax payment with the FTA within 9 months from the day when their respective tax period ends. So there might be a few taxpayer who feels that they are qualified for tax refund. Okay, so they can definitely apply for refund purpose with the FTA, but again, they will have to prove that they are entitled for such tax refunds. Now, there is no transitional rules, which means that if there has been any profit or if there has been any losses or expenses that arises before the corporate tax comes into effect, then such amount will not be considered for calculating taxable income or loss of a particular company. Lastly, for small firms, for startups, the corporate tax regime might allow some sort of relief when it comes to financial and reporting duties. Okay. And the reason for the same is just to keep their administrative burden to a minimum level. Moving on, in this slide, we will just understand the tax filing and payment deadlines. So in the beginning of the presentation, we discussed that the corporate tax law will be applicable for the financial year that is starting on or after June 2023. And the tax payment deadline for the same would be 9 months. So let's just say your financial year ends on 30th June. Okay, so your corporate tax period would be 1st July 2023 to 30th June 2024. And your first return filing deadline for that tax period would be 31st March 2025. Now, if your company's financial year ends at 31st December, then your corporate tax period would be 1st January 2024 to 31st December 2024. And the first return filing deadline would be 30th September 2025. And if a company is following a financial year ends at 31st March, then their corporate tax period would be April 2024 to 31st March 2025. And the first return filing deadline would be 31st December. In nutshell, your first financial year will be after June 2023, and that would be your first corporate tax period. The next 2 points is about registration and deregistration. Any firm or any company that is subject to corporate tax, it has to get itself registered with FTA and obtain a tax registration number. But in few cases, some business or some companies, they might fail to register themselves due to some reason, or they may not register themselves voluntarily. Then in such cases, FTA will register those entities automatically. Similarly, if a company is liquidated or it ceases to exist for some reasons, then the company is required to apply to FTA for deregistration as well. Okay, and the deadline for deregistration should be done within 3 months of liquidation or closure of business. So this was all about corporate tax, a brief introduction about what corporate tax is. So I would request Mr. Rajiv to discuss the takeaway from this webinar.
Thank you, Ms. Deepa. Thank you for taking us through all the provisions, majority of the provisions of the UAE corporate tax as per the public consultation document. Now we have understood what corporate tax is, to whom it is applicable, what are the compliances, and how we need to comply with the corporate tax, and for the free zone persons, how we can claim these 0% corporate tax, what are the conditions. So now we all know that the UAE corporate tax is coming into effect from 1st June 2023, but the final law for the same is yet not out. So at presently, what we should be doing, what we need to do. First, that we obviously will be waiting for the final corporate tax law to be declared by the Ministry of Finance or Federal Tax Authority. But at presently, what we can do the impact tax assessment, that how the UAE corporate tax is affecting a particular company, that what kind of changes is required in the accounts, like in chart of accounts. Like as Ms. Deepa said, there are some fully disallowed expenses or there are some partially disallowed expenses. So for that purpose, instead of having an hassle after the tax period end, let us create a new chart of accounts as per the UAE corporate tax. Then next is what kind of legal changes, like structural shareholding changes, we can do at now. We can think for that what is the best corporate tax structure, or what is the best shareholding structure which gives us a better tax planning, not a tax evasion, not to avoid the taxes, but a better tax planning that what could be our shareholding. But the effect has to be given after knowing what is the final corporate tax law. At presently, we should hire a qualified and professional accountants who can handle our various compliances. As we all know, like like up to 2016, we do not have any kind of compliances, no compliances in UAE, except the compliances as per the free zone regulations or as per the mainland companies law. But slowly and gradually, every year, we see one or the other compliances or indirect taxation or the other kind of compliances, like starting with 2017 excise, then in 18 we have value added tax, anti-money laundering, 2019 ESR, then again 2020 ESR and the UBO, and now 2022 we already have the public consultation document of the corporate tax. So now this is the need of any company, that they should hire a qualified and professional accountant who can handle this many compliances, from no compliances to too much compliances on corporate tax, VAT, AML, ESR, UBO. And before the UAE corporate tax comes into effect, like from 1st June 2023, we should prepare our financial statements. We should prepare the financial statements which reflects the correct picture of a company, meaning thereby that there should not be any undisclosed income, expense, assets, or liabilities. So now we have a time to correct our books of accounts, to show the real picture in our books of accounts. And the businesses, by doing this, what the companies will achieve: one, that they will pay the corporate tax based on their actual businesses, their actual books of accounts, and they can be, the shareholders can be able to create the capital in their books of accounts to support their investment and spending proof. Let's say that a shareholder in future buys one posh villa, let's say a 10 million dirham. So that time might be the government or the federal tax authority can come in and ask you, ask the shareholder that from where you got this money. So if that shareholder, that company has maintained the proper books of accounts, created the capital, so they can show to the authority that yes, this is my capital and my company is paying the full corporate taxes, and this is the capital from which I bought this villa of 10 million pounds. So these are our major key takeaway. With this, we came to the end of our presentation. And before we end our presentation, from the panelist side, me, Mr. Rajiv Thakkar, and my colleague, Mrs. Deepa Rai, we would like to thank SRTIP, Sharjah Research Technology and Innovation Park, to provide us the opportunity to provide our insights on the UAE corporate tax. We thank you, SRTIP, for giving us such an opportunity. Uh, thank you, our investors, the investors of SRTIP, for joining us today, this morning, for the understanding of the UAE corporate tax, as per the public consultation document. Over the screen, you have our contact details. So if you want to contact us, you can contact us through any of the channel you like to wish.